Hi, I'm Stock Investor Davis. Welcome to the channel. The question at hand, what does a rosy 2025 outlook look like for ASML? In this video, I'm going to answer that question and more. Before we get started, please tap that subscribe button. And if you find this video informative, give it a like. Let's get started. To provide a little bit of a background, within its most recent earnings, ASML mentions that it's modeled an opportunity to reach an annual revenue between 30 and 40 billion euros by 2025, with gross margins between 54 and 56%. For reference, this year's sales were 27.6 billion euros with a 51% gross margin. Pausing right here, the company is not far away from reaching the lower end of this projection. Continuing the timeline, management has already guided a flat 2024, noting similar sales relative to its 2023. I posted a valuation video for the company considering this guidance. The link is in the description. I ask again, what does a rosy 2025 outlook look like for ASML? Due to this being a long-term projection and management not guiding us any further than what's already been previously said, I'm left to make a lot of assumptions here that appear reasonable to me. I've set up two scenarios when looking out to its year-end 2025. The first assumption and only difference between the two scenarios presented is the revenue increasing by 15%, which is the two columns on the left, or increasing by 30%, the two columns on the right. I find this range in growth reasonable as the company achieved a 25% revenue growth in its fiscal year-end 2023 compared to its 2022, and has a projected flat year in terms of growth during 2024. The 15% growth allows the company to reach that range between 30 and 40 billion euros and is effectively the average growth of the past year and the high growth or the projected 2024 year. The 30% growth shows what it might look like if the company returns to a high growth year similar to its 2023 results. Also, this projection isn't too far off from a scenario where the company has solid bookings throughout its entire 2024 year, similar to its fourth quarter 2023. The highlighted columns represent USD and are using today's exchange rate, which is expected to change. The other assumptions I'm making include gross margins 55%, operating expenses increasing by 10% of its projected 2024 results, non-operating items relating to interest, other or equity investments are set to 0, which is highly conservative, a tax rate of 16.5%, shares outstanding decreasing to 388 million shares, and the exchange rate remaining at €1 for every $1.08 in USD. So clearly a lot of assumptions which get us a projected bottom line of between $26.50 and $31.79 in earnings per share. Now let's apply those potential scenarios to our valuation tables. The first estimate, its price to earnings valuation using the 15% revenue growth scenario. In a previous video, I established a reasonable PE ratio range of between 27 and 38 times its earnings. I recommend you watch that video. The link is in the description. Using that range of 27 to 38 times its earnings and multiplying it by the projected earnings per share in 2025 of $26.50, we find a fair value price of between $716 and $1,007, resulting in the current price of $890 being fairly priced, slightly favoring the seller side. Keep in mind that this is using a 2-year outlook with a heck of a lot of assumptions. That will be the case for our valuation measures going forward. Pivoting to its price to sales valuation using the 15% revenue growth scenario. In a previous video, I established a reasonable price to sales ratio range of between 7 and 11 times sales. Again, the link to that video is in the description. Using that range of 7 to 11 times its sales and multiplying it by the projected sales per share figure in 2025 of $88.22, we find a fair value price range of between $618 and $970, resulting in the current price of $890 being fairly priced, favoring the seller side. Next, it's price to earnings valuation using the 30% revenue growth scenario. Note the change in our assumptions on the right-hand side. Again, let's multiply this scenario's earnings per share of $31.79 by the same earnings multiple of 27 and 38. After doing that, we find a fair value price range of between $858 and $1,208. Considering the current price of $890, it's fairly priced, heavily favoring the buyer side. Shifting to its price to sales valuation using the 30% revenue growth scenario. Again, using the range of 7 to 11 times its sales and multiplying it by the projected sales per share figure of $99.72, we find a fair value price range of between $698 and $1,097, resulting in the current price of $890 being fairly priced, slightly favoring the buyer side. Applying these four projected valuations to our technical chart, we can see on the right-hand side the areas that correspond to the highs and lows of each scenario discussed. The green boxes indicating the bottom of the range and the red boxes indicating the tops of the range. It's a bit congested here, but a couple items I want to point out before concluding with a summary. Circled in pink, I want to emphasize two uptrends currently in play. The top circle that stretches across the screen is an uptrend noted beginning in July 2022. This is the uptrend the stock price is most aligned with today. If it continues at this pace by year-end 2025, it will be near the top of the highest valuation measure we calculated, which is the 30% growth scenario using its price to earnings. The bottom circle that stretches across the screen is an uptrend noted beginning January 2019. If this stock pulls back into this more conservative range by year-end 2025, it will effectively be within all the fair value price ranges we established. Considering these two ideas, it's worth mentioning that the company oftentimes will far exceed the 2019 uptrend, which brings me to the horizontal box circled on the right. At this time, this is the price range I'm estimating the stock price will be by year-end 2025. Essentially, somewhere between the two uptrends scenarios. To conclude, I want to share some percentages to help explain why I'm not a big fan of the company's stock price right now. On the left, we see the price today compared to the high and low points of our forecasted scenarios or valuations, along with my price forecast at the bottom. Note that when considering all the scenarios, it's fairly evenly split between going up or down. This may not sound bad, but when considering these are the projected price points for after 2 years, it doesn't appear too favorable to me as an investor to add now. Because if I want to catch the upside, I need ASML to deliver big. Anything less than good or great results, and the investment could go negative or have a minimal return percentage. Alternatively, on the right-hand side is my current desired price point, which may not occur, but I'll be watching to see if it gets closer to this price point of $720 in the next year. If the stock price can pull back closer to my desired price, we can see a big difference in the change percentage at the various forecasted valuations, nearly eliminating the likelihood of a loss occurring and providing the gains I seek. This is all to say, I don't mind buying a stock with a higher valuation, but when the valuation today leaves no room for error over the next 2 years, there's bound to be a better opportunity available further. If any slight hiccups happen, there will be a pullback in price. Will it pull back to my desired $720 to $750 range? Maybe. Will it pull back into the low 800s? Probably. Of course, we'll see how it all plays out over time. For now, thank you for watching. Please subscribe.